Welcome to Finance Deep Dive. You ever wonder why the value of the dollar seems to be up one day and down the next? Well, in this video, we're going to break down the powerful forces that make currencies rise and fall. So what is it that makes the cash in your wallet worth more one day and less the next? I'll tell you, it's not random. It's all driven by this massive, interconnected global system. All right, first things first, let's get the basics straight. A currency? It's simply a country's official money. Easy enough, right?
You already know the big ones, of course, like the US dollar.
The euro, which is used all across Europe. And the Japanese yen. It's a global thing, and they're all being treated against each other constantly.
Okay, so how is the value of one currency decided against another? It might seem super complex, but it turns out there's a really simple rule at the heart of it all.
It all just boils down to two words: supply and demand. Think about it. If a ton of people around the world want a particular currency, maybe to invest in that country or buy its products, all that high demand makes its value go up. And on the flip side, if fewer people want it, maybe because that country's economy is looking a little shaky, its value drops. It's really just a constant global balancing act. So what actually drives that supply and demand? It really comes down to four key factors that everyone, from governments to global investors, watches like a hawk. First up on the list, interest rates. Think of interest rates as the return you get for holding a currency. So when a country's central bank raises its rates, global investors want to buy that currency to earn that higher return. This flood of buyers increases demand and, boom, pushes the currency's value up. All right, our second driver, inflation. Inflation is kind of like the silent thief of value. If a currency is losing its purchasing power, meaning your dollar buys fewer groceries this year than last year, it becomes way less attractive to hold. So people sell it, and that lowers its value on the global stage. Number 3 is a huge one: economic stability. Let's be real, money flows to places where it feels safe and has a good chance to grow. A country with a strong, stable economy inspires a ton of confidence. Investors see it as a safe haven, so they buy the currency, and that makes its value stronger. And finally, number 4, the trade balance. This is basically a country's global shopping bill. If a country buys more from the world than it sells to the world, it constantly has to sell its own currency to buy all those foreign goods. All that selling pressure pushes the value of its currency down. Okay, that's the theory. Let's look at a quick real-world example to see exactly how these factors play out. So, not too long ago, the U.S. Federal Reserve started raising interest rates to fight inflation. Meanwhile, Japan's central bank kept its rates really low to try and stimulate its economy. And what happened? Investors rushed for the higher returns they could get by holding U.S. dollars. This drove up demand like crazy and made the dollar's value much stronger. At the same time, with those lower rates in Japan, global demand for the yen fell off, and that caused its value to weaken. It's a perfect example of interest rates in action. So after all that, why does any of this actually matter to you? Because these huge global shifts directly impact the cost of things you buy every single day. Let's break down what a strong US dollar versus a weak one really means for your wallet. When the dollar is strong, goods from other countries, like a new phone from South Korea or a car from Germany, actually become cheaper for you to buy. But when the dollar is weak, those same imports get more expensive. Now let's flip it around. A strong dollar makes American-made products more expensive for other countries, which can hurt U.S. companies. A weak dollar, on the other hand, makes our exports a total bargain for the rest of the world. If you are liking the content, don't forget to subscribe. It motivates us to keep posting.